Have you ever trusted the bullish or bearish candlestick patterns on Forex only to end up losing money? Patterns like the Doji, spinning top, bullish engulfing are often praised, but do they really work in real trading strategies? In this video, I'm going to test 9 different single bar patterns on 27 Forex pairs to find if any of them hold a real advantage. I received many questions through my different channels, and recently I received 2 that I'm combining in this video. One viewer was asking me why I don't do more Forex videos, and another question came from my student who asked me how to find single bar edges. Now, both of them mentioned the algo versus scrap workflow. This is a workflow that I developed to test and compare different indicators. Usually they are oscillators, and I tested them on the futures market. And you can watch that series on my channel. But this is a new series where I'm going to test on Forex markets. Also, I'm going to test patterns and not indicators. And the whole point is to find if there is an edge in any pattern we test. And if they do, then we can exploit that edge by building strategies using that pattern. You see, most traders just try to build strategies out of thin air. They usually come up with an indicator and just put it on their beloved market, and they just want to make that work, so they end up by over optimizing. And that is not the right way to build robust strategies. Robust strategies start from a great foundation, which is what is the market characteristics, meaning the market tends to go up, tends to go down, tend to play well with mean reversion or breakout, and so on and so forth. And then you try to find an edge from an indicator or a pattern and match it with that market. Although you can develop and test hundreds of patterns, in this video, I am going to test a single bar pattern. These are usually candlestick patterns. This is the definition of candlesticks. So usually every bar has 4 points: the open, high, low, and close. And if the bar is up, meaning the close is above the open, usually the bar is painted green. And if the close below the open, usually the bar painted red. Now, the range of the bar is the total travel distance. So that's the high minus the low. The body of the bar is the difference between the open and the close. And then this part above the body is called the upper wick or upper shadow. And then the lower part, which is below the body, is usually called lower wick or lower shadow. Now, you might find this sometimes painted black, but these are the colors that I'm going to use. And when you see me painting something blue, that means it doesn't matter if it's green or red. Usually this is for Doji patterns because the distance of the body traveled is very small. So this is a chart, and as you can see, these are all candlestick patterns, and they come in all different shape and sizes. And so, for example, this is called the Doji, this is called the spinning top, and so on and so forth. So as I mentioned, you can have multi-bar patterns. In this video, we are testing single bar patterns. So this is the first pattern we are going to test. It's called the hammer. It's a 1-bar pattern. And this is the definition. So the definition is very important because if you play with the definition, it will present a different bar. And also you need to be very careful when programming these patterns because you can easily include other pattern in the same definition without recognizing it. So you need to pay attention to your coding. And here I put the simple English language to define the pattern. So in this case, the body, this part, has to be lower than 35% of the total range. So that means this body can be up to here or smaller. But also the body is not a doji, meaning the body should not be very, very small. And here the close is above the open, that's why it's green. Also, the body high is equal to the range high. So you see this one, they are very close together. Now, in reality, I put a 5% tolerance. That means the body high can be 5% lower than the high. And then we need the lower wick. So this part, we need to be 2 times greater than the body. And so that's what I'm saying by you need to be very careful when programming these patterns to see it. So I built an indicator to show these patterns on the chart. So here is the first pattern recognized by the filter. As you can see, this is the hammer, and you can see here it looks like a hammer, but it has a little bit of space on the top. And that's what I said, that I leave about 5% allowance tolerance between the body high and the actual high of the bar. The second pattern is the hanging man, which is exactly the same, except the close is lower than the open, and that's why you see the top is red. It's like the hammer, but it's red. Here is another one, and as you can see, this is show us completely like this one. The third pattern is the inverted hammer. So in the inverted hammer is like the hammer, but it's on the opposite side. And again, we have inverted hammer, and this one is called shooting star. Although both are the same, one is green and one is red. So this is pattern 3, and as you can see, it's green. And this is the red pattern, which is pattern number 4. Then we have pattern 5, which is a dragonfly doji. And this one is blue because it doesn't matter if this is green or red, because the distance traveled is too small. And as you can see, the body is 7% of the range. That means the difference between the top of the body and the lower of the body is lower than 7% of the range of the bar. This one has to be in the top 30% of the range. Then we have the gravestone doji, which is just the opposite, in the bottom 30% of the range. And then we have the long-legged doji, which is basically when this one sits in the middle. So it's not in the top 30, it's not in the bottom 30, it's in the middle 40% of the range. Pattern number 8 is a spinning top, which is same as the long-legged doji, except the body is bigger than 7%. So you see the body is bigger than 7%, so it's not a doji, but it's less than 35% of the range. And then the last pattern we are going to test is the opposite. So this one is the same as the spinning top, but this one is red. So when programming any pattern, you need to pay attention to the logic behind it. So you should put it on paper and then test each pattern separately to see if it really means what you are thinking of. So when you put it on paper and you draw it, and then you test it on your chart and you see what pattern shows up and if it matches your pattern that you drew on your paper. I say that because even with my experience in programming, I still make mistakes. And for example, when I program these new patterns, I found like they overlap sometimes, and I had to put other conditions so that they don't overlap each one separately. Of course, you can combine them once you have the logic figured out. So for example, we can combine all the doji patterns as one. So for example, I have the USD JPY market here. The data here is since 1999. And these are the patterns tested with holding 1 day. So we enter, we exit, end of day. And as you can see, the number of trades is very, very different. And then the spinning tops are the most common pattern. So this is the spinning top green, spinning top red, and this is the doji in the middle. So long-legged doji. So this test shows that the patterns produce different results on the same market, and this is expected. But really, to find an edge, we need to take it a step further. And here I will introduce you to my workflow that is called Algo versus Crap. Now, for you who are watched this series before, I usually tested using indicators on futures market. And this time, I will use Forex markets and I will use the patterns only. Let me explain the workflow. This is the Forex edition. So we start with the chart setup. All the testing will be on daily bars starting in 1999 and ending in 2024 in November. Then I load 27 Forex pairs. The Forex pairs are combinations of these Forex markets. So US dollar, euro, British pound, Canadian dollar, Australian dollar, Japanese yen, New Zealand dollar, and Swiss franc. Then I will use two styles to trade. So one of them is mean reversion, one of them is breakout. The difference is, for example, let's say I found the pattern. If it's mean reversion, then I will buy below the low. And if it's a breakout, I will buy above the high. And then I will do two directions, which is one of them is long, one of them is short. So that means every strategy will have a single direction. And then I have two order types. So for example, going back to mean reversion, if I'm buying with mean reversion, then I will use a limit order to enter below the low. And if I'm using a breakout, I will use above the high stop order. I can also use just buy the market, which is when the pattern happens, I will just buy the next day. So this will ensure I will enter the trade no matter what. And finally, I have 5 exits. Now, all the edges I'm testing are short-term edges. That's why I'm testing these exits. So end of day, which is very, very fast, 2 bars, 3 bars, 4 bars, and then this can be considered a short-term trend following, which is maximum of 12 bars or profit target of 2 ATR 20 or stop loss of 4 ATR 20. Now, once I do the optimization, I have 2 styles, 2 directions, 2 order types, 5 exit and 27 Forex pairs. So I will end up with about 1,000 strategies and about 125,000 trades. So in this case, I'm testing 9 patterns all together. So we should end up with about 10,000 strategies and about 1.2 million trades. Now, once I do all this, I collect all the information, put them in a spreadsheet as a database. Once I have the database, then I can use a filter. Now, although this says to test for robust strategies, remember these are only edges. These are not complete strategies yet, but these are the nucleus of a really good strategy. So we have the full database, and then we filter on robustness, and we keep the good ones in the filtered database. And this is how the full workflow looks like. Now, this database currently holds only 9 single bar patterns. Now, in the future videos, I will be doing 2 bar and 3 bar and 4 bar patterns. And the whole idea is to gather a database of edges. And the edge is the starting point of building a robust strategy. So instead of just trying to build strategies on the market you love, it is a much better, in fact, it is the only profitable way that I know to start building a strategy. So instead of trying it randomly, you start with an edge. So you already know that this pattern will be profitable. You just need to help it out by maybe adding a filter or changing your risk measurement or changing the exit and so on and so forth. And here is the database of the 9 single patterns tested on 27 Forex markets. So as you can see, we have 10,000 strategies in the database with about 1.1 million trades. And these are the filtered strategies that pass my robustness filter. So as you can see, out of the 10,000, I only have 261 strategies. Again, these are edges. I keep calling them strategies because I use a strategy to test them. And the current 9 patterns are listed here. So the hammer, hanging man, and so on and so forth. And the sorting here is by the number of strategies. So if I sort on this one, you can see that the number 1 is the spinning top. So spinning top has the most robust edges on all markets. And then the hammer is the least number of edges on all markets. And then everything else in between. But also you can see here that the red spinning top, which is the same like the spinning top, except this one is red, this one is green. This is number 3. And we can easily combine these as the best edge. Now, why would you want to combine different patterns together? Because these are kind of the same. I mean, spinning top, green or red, they are basically the same thing. Body is in the middle. The dojis, again, are the same thing. Because what I want to get is more trades. Because the more trades I have, the better use of filters that I can add. So adding a filter will always enhance a strategy. So I'd much rather have more trades than like a high accuracy edge. I just want a small edge, but a lot of trades. So now we will dig deeper. And these are the Forex pairs. Here something pops up, which is not all markets behave the same way. And this does not come as a surprise to my Algo Trading Masterclass students, because they already know this, that not all markets are the same. And some has really good edges, either in breakout or mean reversion. And some just usually have no edges at all. And it shows up also here. So for example, look at this. The Euro Australian dollar has only one edge out of the 260. Same thing for Canadian dollar, Swiss franc. Same thing for British pound, Swiss franc. The yen here, Japanese yen, Australian dollar, 33. Japanese yen, British pound, 41. Japanese yen, euro, 31. Japanese yen, Swiss franc, 34. And also Japanese yen, US dollar is 30. So Japanese yen is the common denominator in all these. So here are the JPY pairs. And now we can see that the Canadian dollar is the lowest. So when you look at an edge like this, why would you trade the Canadian dollar and Japanese yen? Because this is producing the lowest amount of edges. And then all of these are producing good results. Okay, so now we have the Forex pairs with the highest number of edges. And now let's identify the patterns. So let me bring the pattern identifier and put the market here. So again, we get more information here. So the spinning top is the best. Long-legged doji, hanging man. Actually, they are all good except for shooting star and the hammer. Remember, these are the first two patterns. So this is the hammer and this is the shooting star. So we don't want to use these patterns. So let's pick the spinning top. So these are all the Japanese yen pairs, and let's pick the spinning top pattern identifier. So this is the spinning top. So we have 15 mean reversion and 23 breakout. So the breakout has a higher edge than the mean reversion. And also the long is more than the short. So we can go breakout long. So let's pick a breakout and long. And this is what we end up with. We have the Swiss franc Japanese yen with 4 strategies. Euro JPY 1. British pound JPY is 1. US dollar versus the Japanese yen. We can easily use the spinning top to build a breakout strategy on the long side. And as you can see here, we have multiple exits. 3 bars, 12 bars, 4 bars, 2 bars with a stop because there's a breakout. So stop order or market order. And that's the whole point of this exercise, which is to find real edges on markets, not by starting from the market you love, but by starting from the edge on that market. So for example, here we found easily that the USD JPY has a really high edge using the spinning top pattern. Breakout style, long direction. If you like this video, then you will love the next one.